Morning, ladies and gents. Afternoon, even. That's a first mistake. Thank you very much for joining us for this panel on yield compression, falling returns, rising purchase prices. Where are we headed? Hopefully, we'll get some answers. With record low interest rates and bond yields throughout much of Europe and the world, the returns on offer from real estate makes the sector arguably look, on a relative basis, more attractive than ever. As a result, we're seeing some of the world's largest institutions substantially increase their allocation to real estate, and as a result, there's a wall of money for some assets, driving pricing up and yields to record lows. We have an excellent panel here today to discuss how this phenomenon is impacting the property sector and how investors should react in order to make the most of it. I will, of course, be asking them questions throughout, but we will have plenty of time for Q&A at the end, so please don't make me do all of the hard work. Think of some questions of your own, and you can interrogate them much better than I can. Right, well, can we start off just by asking each of you to introduce yourselves briefly and your role at your company? Tom, start with you.
Hello, my name's Tom Leahy. I work for Real Capital Analytics as the Director of Market Analysis in Europe. So RCA is originally a US business, but we are a provider of data and market analysis on the global real estate investment market. So we have a database with $16 trillion of investment transactions in going back to 2007. So we have clients throughout the industry who rely on us for reporting purposes, data provision and market analytics.
Franz.
Good afternoon. My name is Franz Jurkowitsch. I'm CEO of Varimpex. It's a Vienna and Warsaw listed real estate company. We are developers and we are also invested in most of our assets, specialized in hotels and office buildings.
Annette Kröger. I'm CEO of Allianz Real Estate Germany. Allianz Real Estate is the asset and investment manager of Allianz Insurance Group, which bundles all real estate activity of Allianz Insurance Group. We have a portfolio of roughly 42 billion of real estate worldwide. Around 3/4 of that is equity, and then we also have a loan book, which makes up another roughly quarter of the overall portfolio. And we are clearly a growing platform, so this year we invested around 7 billion to date in additional real estate. Myself, I run the German business, which covers the region Germany, Austria, CE, Nordics, and also Ireland.
Stefan, Ziegler, Managing Director of KGL. We are a little bit smaller than Allianz. We are an asset manager in Germany. We have roughly 22 billion assets under management. We are setting up funds for institutional, mainly German clients, for infrastructure, real estate, and aircraft funds.
Fantastic, thank you. Well, to be perfectly frank with you, we were supposed to be starting off with a presentation from Tom. The slides aren't quite here yet. We don't want to deprive you of that, so we'll come to that later. So we're going to have a few questions. Tom's going to do his presentation, and then we're going to come back to the questions. So let's kick off with just setting the seed more broadly. This low-yielding environment that we're in at the moment, and we've seen substantially change over the last couple of years. Do you think this is a moment in time, or do you think this is an environment that we're going to see over the long term for the next 5-10 years? How about you, Tom?
Closest one. Yeah, I think, as everyone knows, we're in an environment at the moment where everything's being driven by what central bankers are doing. If you look at Mario Draghi, Mark Carney, Janet Yellen, they are the drivers of investment markets globally, not just real estate, but equity markets and bonds. Certainly in Europe, I can't foresee the current low-yield environment changing for the foreseeable future. If you look at the yield curve at the moment, it's very flat in the short term and in the long term, which is making life very difficult for banks. But for real estate investors, it makes the 3%, 4%, 5%, 6% income yield you get from real estate very attractive. So you sort of hesitate saying this is the new normal, or it's different this time, or things have changed completely. But I wouldn't foresee it, interest rates going up anytime sooner in Europe, and that then creates an environment for real estate investors to work in.
Annette, does that match your view and your kind of over the medium term horizon?
That very much matches the view that I and Allianz as a company has as well. I think the low interest rate environment, given the whole economy that we're operating in, and the low bond yields, interest rates, is here to stay for the medium term. And that's definitely an environment we will be operating in for a while. It would need to be some larger external event that would change that, and right now it's a bit hard to foresee where that would come from. Is it the new normal? I agree. I don't want to commit to saying it's the new normal. I would be surprised if the very low that we're seeing now is going to stay forever, but I would be less surprised if we are, in a longer term, in a slightly lower environment.
And just to stay with you for a moment, Annette, to what extent can you allow that macroeconomic factors to dictate the way in which you kind of invest in property? Is it something you kind of have to put to the back of your mind, or do you kind of take it largely into consideration with kind of the investment decisions that you're making?
Well, I think for us, investment decisions, they still always have to be sound from a real estate perspective, and we need to look very closely at the assets, at the risk, at the underwriting that we undertake, so that the cash flow that we're projecting is really something we can achieve. And then in terms of the yield at which you're buying in, you are, of course, in the environment that you operate in, and as an insurance company, we have to allocate our capital, and if we have 0% interest rates or less in other asset classes, then clearly there's a focus on real estate and other alternative assets, which is very much at the heart of our activity right now. And therefore, that's an area for us to push and to generate more yield, even if it feels expensive purely from a real estate perspective.
Sure, you say it's at the heart of your investing at the moment. Have you increased your allocation? Has Allianz increased its real estate allocation?
Well, we have grown significantly over the last years. We're at a bit above 40 billion in terms of a portfolio now, and the target is to get up to 60 billion. So yes, we're doing that both on the real estate side and also other alternative assets like infrastructure.
Stefan, have you kind of seen more investors and different type of investors kind of come in and look to invest in real estate in recent years simply because of the yield play?
I mean, it's for sure. I mean, what we are seeing right now is that a lot of foreign investors are coming to the German market, bidding against us because we predominantly, I mean, especially for real estate, invest in Germany, and there is really a lot more of competition. Also, when we are on the seller side right now, we are selling right now a huge chunk of real estate in a smaller city, and Korean is going to buy it, for about, in the range of 180 to 220 million. I mean, you see a lot of foreign interest in the German market, which makes it harder for us.
But have you had new investors come from different parts of the world into your funds?
So far, we have predominantly German investors, but we are currently in the process of raising more funds outside of Germany. But, it's a journey. We just started it and see how we can adapt as a pure German company now to the requirements the foreign investors have.
Sure. Perhaps it might make the job a little bit easier in the yield environment.
I don't think so, because our preliminary talks to the foreign investors always they're looking for much more return than we can generate in the kind of core environment. So far in the past, we have been mainly core investors, and when people are coming from, let's say, from the Netherlands or when they're well advanced, but from Finland, etc., these guys are looking for 6 to 7% returns, which I don't see for high quality assets in Germany. It's not longer possible. I mean, we are buying now assets in Class A office building in really good locations. You are up to 22 times rent, which is below 5% cap rate. Yeah.
So there's just an unrealistic expectation from investors. Do you think hopefully that will change with some education, perhaps, or?
I think you have to do a lot of education. I mean, we are doing this, especially for some of these investors, and it pays off. But again, it's a long-term play, and the market is not helping you because it's getting almost more expensive.
Franz, where are you seeing value at the moment? We've seen yields come in enormously. You guys operate quite a lot in Eastern Europe. Is that playing into your hands where you can get slightly higher returns?
I think Eastern Europe is bound for a yield downshift. That means after Lehman, most of the Eastern European markets, maybe with the exception of Poland, which wasn't hurt so dramatically, had an increase in cap rates, and also the volume has been in decline. And nowadays, Poland is somehow on the forefront, again with a significant yield shift in the past and still some further downshift of yields, especially in secondary cities. Warsaw is already in a quite, let's say, low yield area. But if you look on other markets like Hungary, and Hungary was very much in the, let's say, in the focus of Western investors, still the yields are relatively high. So if you compare it, and if you compare the risk, and you have a good Class A office building or shopping center, I would say that there is a lot of potential there for investors who invest today and still get a relatively good return. Yeah? And an upside, because values will grow once the yields go further down.
Are there any particular subsectors that you find attractive in those markets?
I find the office market in Poland also in the big secondary cities interesting. Warsaw is more liquid but has more competition. I think Budapest is interesting because the yields are still higher compared to Warsaw. Prague and also Bucharest is coming, because you have to look a little bit also at the growth rate of the countries. Poland and Romania have dramatic higher growth rates of GDP than we have in Germany or Austria.
Yeah,
and this creates demand. Yeah.
And Poland didn't really have a recession at all.
Also, yeah.
Yeah. Okay, fantastic. Well, I think we're ready for a presentation. I don't want to hold you up any longer, Tom. You good to go?
Chomping at the bit.
All right. Well, sorry to hold you up. Without further ado, we'll have Tom.
Okay, so this was going to come before we all started speaking to set the scene slightly, but nevertheless, here we are, so we'll kind of crack on with it. So I was asked to do a presentation using mostly RCA data. So like I said, we have this big database of real estate investment transactions, so we can track what's happening in the market in terms of pricing and capital flows. So we're obviously focusing on yield compression and rising prices, so that's what I'm going to be presenting some slides on. So just quickly to set the scene, there's a lot of capital coming into the market, despite the slowdown that we've seen in the first half of this year in terms of investment volumes in Europe. They're still above average, so there's still a lot of money out there invested into real estate and money that wants to be invested into real estate. And so what that's done is it's shifted down yields. So this chart shows yields in London, in the sort of what I've called the Western European metros, so that's Paris, German A cities, Amsterdam, etc., and also CE markets as well. I think it's interesting here that you can see the kind of the progression of the market in terms of yields in London started to come in first. Then as capital moved out of, moved into the Western European markets, we started seeing investment grow. Yields started coming in those markets too. And then finally that top line, which feeds into what Franz was just saying about Central and Eastern Europe, we finally started seeing yields move in this year in those CE markets. So that's the effect that the weighted capital is having on pricing. So I've got that by market, also just split down here to look at it by sector. So here we've got industrial, office and retail across Europe. You can see very strong yield compression, especially in the industrial market. And I think that feeds into the narrative in terms of investors wanting yield. So the hunt for yield has really pushed down yields in industrial especially. And especially when we sort of think about industrial, it's really the logistics market that's driving that. And one of the reasons is that if you buy long-let logistics to Amazon or to a blue-chip retailer, then it has it's like a bond-like proxy. You know, you might get upward-only rent reviews, 25-year leases, and that's really driving down yields in that sector of the market especially. Just thinking about, rather than looking at market-by-market yields, what I've got here is the split of yields in the UK, France, and Germany by percentile, so 10th, 25th, 50th, and 75th, and you can think of those as proxies for the quality of the assets. And what you can see on this chart is that the yield compression has really been driven from or by yields coming in for the best quality assets, so that's the 10th and the 25th percentiles, and that really reflects where investor demand is. What we haven't seen is significant yield compression coming in for the lower quality assets, so that's the 75th percentile line. And so what that's done is it's created a bigger gap in pricing between the top and the bottom quartiles. I think these latest numbers show that 75th percentile line has started to come in slightly, and that maybe reflects the weight of capital in the market and the fact that investors are starting to pay a little bit more for secondary stock or stock in secondary and tertiary markets. just to sort of put all this in context, though, because this is, although we're talking about Europe, yield compression that we're seeing is a... Hold on. There we go. Not pressing it strongly. The yield compression we're seeing is a global phenomenon, so it's not just in Europe. And this chart shows office yields in a sort of succession of major metros around the world. And you can see, with the odd exception, yields in most of these markets are below average, and they're also towards the bottom of their range. And that kind of reflects the globalization of real estate as an asset class. You know, we're seeing Asian investors, Middle East investors, US investors buying real estate all around the world. And so what that's doing, it's leading to a bit of a convergence in pricing for assets. What you'd also say as well is some of these buyers are coming from markets where prime yields are maybe 2%, 2.5% in Asian markets like in Taiwan, in Hong Kong, but yields that are structurally lower. So when these... there we go. When these buyers are coming and they're buying European real estate, and I've got here office yields by the sort of origin of the buyer in Europe, you can see that the Asian buyers are buying at lower yields. Now, partly that reflects the assets that they're interested in, so they're buying more prime assets, whereas if you look at the North American buyers there, they tend to be more value add, and so they're buying at a higher yield, maybe, you know, secondary quality assets. But the fact that we've got Asian buyers here in Europe who are used to buying prime stock at 2%, 2.5%, and they're now buying prime stock at maybe 3.5%, 4%, 4.5%, and that's also acted to drive down yields. That globalization of real estate as an asset class has also driven down yields. So the movement in yields has clearly, you know, very obviously had an effect on pricing, and that's driven pricing up. So this is a sneak preview of some transaction price indices that RCA has developed with MIT in the US and the University of Amsterdam. And this basically shows the change in transaction prices for office assets in these markets I've got on the slide here. And so with the exception of Amsterdam, notably, prices in all these markets are above the levels we last saw in 2007. So that really quantifies the effect that the yield compression has had on these markets. So if you look at somewhere like London, where we've seen very strong yield compression in the last 3 to 4 years, prices are 70 to 80% above where they were even back in 2007. So significant upwards movement in pricing across Europe, really. So with yields moving in, yields moving in, returns have started to fall, and so that comes to the second part of our presentation, falling returns. So this is a chart I've borrowed from our friends at MSCI, formerly IPD, who track the market, and it shows returns starting to fall away. And that's really what you'd expect at this point in the cycle. We're at a very mature stage in the cycle. A lot of the yield compression has already happened, and that's already driven those very high returns we saw in 2013. With yields started to come in, yield compression is starting to slow, we're seeing returns falling back down towards their long-term averages. So, sorry, I'm having real trouble with this clicker. Okay. Okay, so where next? That's the last part of our discussion and the last part of my presentation. So 3 more slides before I can give this clicker up. First of all, what we've seen, this is kind of a question I wanted to ask, really, ask the panel and ask the rest of the audience, is since the Brexit vote in the UK, we've seen a substantial reduction in investment volumes in the UK versus the average, and conversely, investment volumes in the rest of Europe have kind of been around their average for this third quarter of the year. So that, I guess, poses a question of, is that a long-term thing? Are we going to see structurally reduced investment volumes in the UK because of the Brexit vote, and that's scaring off a lot of the international capital that's come to the UK? Or is that a temporary reaction to some of the uncertainty that's been thrown up by the vote? So that's my first question. Second question, yes, property yields have come in very substantially. You know, prime yields are as low as we've seen in a lot of markets. But thinking about that first question that David asked about interest rates, we're operating in a structurally low interest rate environment. And that provides a huge cushion for real estate yields. And this chart shows the yield gap, average yields, I should say, for assets in those markets versus the government 10-year government bond yield. And when you look at the size of that yield gap currently, you think actually there's a bit of room for yields to come in even further than they've already have. So that's my second question. Can yields move in further? Third question, can rental growth drive returns going forward? So yields are structurally low. If you're not of the opinion that yields can come in much further, then investors have then got to look to rental growth to drive their returns over the next 3 to 5 years. So this chart shows rental growth forecasts I got from the IPF, or Investment Property Forum. They're a UK organisation, but they survey market participants. And broadly, if you look at those rental growth forecasts, they look pretty positive actually for real estate investors in most markets. So if you think yields can't go much further, can rental growth take over and drive up returns? And that's it from me, thank goodness.
Fantastic.
No more clicker.
Thank you, Tom. You can put that down now. Is this working? Hello? There we are. Fantastic. Thank you very much, Tom. You can get rid of that dastardly thing. So some really interesting stuff there. So I was just looking at some of the sub-markets that you've been looking at. I think the only ones that were actually above historical lows or averages were Singapore, German A cities, and I think you'd said that pricing in Amsterdam was below 07 levels. Those three markets, anything idiosyncratic about them? Does that show that there's particular value there?
I think the first thing to say is that those are average yields, and those are based on transactions that we have in our database. So I think if you spoke to Annette or Stefan, they'd say to you that yeah, exactly. German cities are not cheap, and they're not cheaper than their average. So I think sometimes you have to be a little bit careful about looking at these average yields. I think in Singapore, speaking to my colleague Petra, who runs our market analysis for Asia, so Singapore, there are sort of some concerns about what's happening in the office market there in terms of possible oversupply. There's a lot of developments coming online there, and so most market participants are of the opinion that Singapore is fairly priced for where it is in the cycle and what's happening on the occupier side. I think in Amsterdam, it's an interesting one. I'm surprised by that line when I saw it, because these are fairly new indices that have just come out. I think maybe it reflects, the Dutch market has been quite slow. The office market has been quite slow to recover from the overhang of excess secondary and tertiary stock. I think we are starting to see an improvement, though, in the Dutch market, and so I would expect that line to start moving up towards its previous peak. So maybe that is a market that maybe looks fairly priced against some of the other major European cities.
You use the phrase kind of very mature part of the cycle. We looked at kind of historic low averages. And there's obviously clearly lots and lots of mitigating circumstances to keep investing. But, is there a rationale to say we should all be running to the hills? Get out. This is way too mature time in the cycle, and kind of be really scared?
No, I mean, I'm happy living in London. I'm not running for the hills just yet. No, I mean, look, a lot of this, again, comes back to this environment that's being created by central bankers. And so when you look at that chart that showed the gap between property yields and government bonds, that creates an argument for investing in real estate. I think, when you're looking at an asset allocation basis, we live in a relative world. And so property, despite the fact, on a historical basis versus its own history, looks expensive in all the markets. When you're looking across sectors and across segments and across asset classes, you can create an argument to continue investing in real estate. I think selectively investing, obviously, but still putting money into property.
You'd started to do my job very well for me, which is start posing the questions that we need to be asking, which is very helpful. Thank you ever so much. So
better than having to answer them myself.
So, first things first, I knew it wouldn't be long before we'd have to get to it. What does the rest of the panel think about Brexit? And any views on whether transactional volumes will be easing off for the long term, or whether it's a short-term phenomenon?
Well, I think what's driving the market there right now is most of all uncertainty. Nobody really knows what the process is going to be, when it's going to happen, what the implications will be. And I think uncertainty is something the market is always very always has a hard time handling. So I do think it is a reduction in investment volumes now while everybody is waiting to see what will happen to the market and will there be a devaluation and how much devaluation will we see. What I also hear from a lot of investors, and I take the same views, is that London is likely going to be there for the long term, and it is a major financial city or a major global city, and people will want to continue to be invested there. So I do think that liquidity will return, but right now it's really uncertainty driving things.
I would be a little bit concerned more for the secondary cities, but not so much about London. I mean, we bought assets in London in 2008, during the crisis, because, we looked at this market for 5 or 6 years before and said, now it's the right time. You should buy now when cap rates are going up to 7 or 6.5, central city. I think they are not there already. Maybe you waited just a little bit longer and then you buy again because, as you said before, it's not going to die. It's not people are, leaving these kind of mega cities. And also there will be a lot of buyers anyway. Foreigners are going in. Maybe not so many Europeans right now, but you have the Asian guys, you have Americans who are going to buy into London. And finally, they will figure something out in respect of the EU relationship and trade agreements. Trade will not stop right now just because of the Brexit.
Franz, what's your view out from outside looking in?
I'm not specialist on the British market, but what I think is that once the FX rate will be on a more stable level, whatever the level will be, and once there will be a feeling, will there be some decline in office demand, will there be relocations of offices from the financial industry and the impact on the office market, then I'm sure it's a good time to buy in London, because the euro is, before the Brexit discussion was and before the big discussions were with the Ukrainian and Russian crisis, we discussed 3 years Greece, and 3 years we had every day in the newspapers that the euro will collapse and so on and so on. There is a high potential, as the euro is covering more than 15 countries, that we will have another discussion on another topic, and then UK and the pound will be an ideal liquid market where you invest. So I would not write off Britain. And if there's a small decline for an investor who is already invested in it, you have to wait. I think the values will maybe not come back fully immediately, but they will be there.
I appreciate we're going slightly off topic here just for the moment, but to flip things the other way around, is there any concern, particularly in Germany and the markets that you're working in, that there's a possible contagion effect? We've got German elections coming up, French elections, US elections. How much is there a concern that this might not just be a UK issue? Sorry, a bit of a tough question, that one. Come on, don't all rush to answer it at once.
One of us has to answer as a German. Since this is not a political discussion, but hard to tell, actually. There will be some shifts to the right-wing side because we already see this. Especially if everybody, watched TV yesterday, you see what's happening in Dresden. This is a kind of, general shift. Will there be a kind of, German exit or something like this? I doubt it. I believe they will stick together to a certain point of time. It could be that the others would like to get us out because we are too strong, but not the other way around.
I blame you, Tom, for you've sent us off topic. Tom, one other thing that I wanted to pick up in your presentation, which showed that Asian buyers in general were prepared to be investing at lower yields. Do you think that will change over time with education, familiarity in markets, and greater propensity to invest in secondary assets?
Yeah, I'm not going to go back to my slides after the trouble I had with that clicker, but if you can recall, I did show, when I showed that slide with the yields by the origin of the buyer, and it's actually showing that the Asian line was actually starting to tick up a little bit. So having gone down to sort of sub 5%, it's starting to go up a little bit. And that, I think, reflects what kind of David's question. We are starting to see some of the buyers move out of the very core cities and buying in, I guess, what you'd not call non-core locations, but maybe the second tier of European cities. So our information shows that actually it's South Korean buyers, the biggest Asian buyers of real estate in Europe so far this year, which is a complete change from what we've seen previously. They've invested over 3 billion euros in European real estate, and that has not by any means been concentrated in London and Paris. You know, we've seen deals in Rotterdam, in Brussels, in Vienna especially. We've seen some capital coming in. So I think, you know, we are, to answer your question, yes, we are seeing that wave of overseas money move out of some of the core markets and into some maybe the sort of second tier centres. You know, in the UK, you've got the Malaysian Employees Provident Fund buying small to medium-sized assets in Birmingham, for example. So not the big lot sizes. So yes, we are seeing that, and that's definitely going to have an effect on what happens in these second tier markets in terms of increased competition and driving down yields.
I'd like to ask the panel what the lowest yielding investment they've made so far this cycle is and why they were prepared to buy at the yield that they were prepared to. Stefan.
I dreaded this question actually. The most expensive one was a building, an office building in Munich we bought for 24 times rent.
And what was so good about it that you were prepared to do that?
I'm not sure what's so good about it, but I think reflecting what the market is providing, we thought, it's a decent asset. It's not longer cheap, but nothing is cheap these days. If you would have asked me to buy this asset 2 years ago, I would say, never in my lifetime. I wouldn't pay more than 18 or 19 times rent for. It's still A-class office building, but you have a multi-tenant building, you have shorter lease terms, things like this. I wouldn't have done it. But these days, it's just what is on the market. And if the location is right, it's again, this is an old head saying buying location. But what we are doing right now is buying location and buying decent rents. The prices are out of control to a certain extent. So what you have to do is protect your investors by buying assets where you have a rent level which you can achieve even in the crisis. What we are doing is it's a kind of crisis protection mode, so to say.
Annette, how about you?
I think for us the story would be a similar one in terms of buying those assets where we see certain growth. We're willing to go in at a lower price, and these, this U.S. markets, for example, where we've seen some growth, but also in the core German office markets, especially Berlin and Munich, so that you can be prepared to buy in at lower yield levels. And for us, it's a combination of buying that core product, but also diversifying into other areas. For us as a global player, this is also very much about diversifying into Asia and the US, which of course are also expensive markets, but it has an additional diversification effect, which is beneficial for us. So it doesn't quite answer the yield question you asked, which I'm dodging a bit, but it is a similar story, having a combination of core, where you see some growth potential in the market, and then diversifying it with other product where you see a bit more yield.
How about you, Franz? Where was your lowest yielding investment?
We are developers. We are not buying at such yields, at such low yields.
You're selling at the low yields.
Yeah, we are selling at low yields, and maybe we sold recently at the sub 6% yield, which was very good in our experience in our market environment. Yeah, so, but Central Eastern Europe is different than Germany or UK. Yeah.
Sure. To come back to Stefan and Annette, just keep going on this. Are there certain markets where you started to think, just no, we can't play there anymore, it's too low yielding, we're going to step back away from?
Well, I think all markets are aggressively priced right now. We are seeing that, especially in the core Western European office markets, there's a lot of liquidity, a lot of competition and very low yields. So we're finding it harder to secure product there, even though it's still at the heart of our strategy, and we will continue to move into those markets. Beyond that, I think if the question is also where is there still potential or where do we see yield expansion, I think it's hard to see. It's just a mix of the portfolio, also looking at some CEE opportunities, for example, where you can get that higher yield in growing markets that we're really targeting.
So since we are not, managing discretionary funds, all our investors have a say in what we are buying. So what we are doing is we are close working with them together and present them the deals. And if they are willing to accept a lower yield, and the yield is always getting lower since the last 2 or 3 years, as long as they think, it's still attractive for them, we buy for them. But saying, this is the lowest yield I've ever seen, I don't want to buy it any longer, I would have done this 2 years ago already. But, since what you didn't buy 2 years ago, now you would have sold it for a tremendous amount of money. Yeah? The question is, what is the alternative? And if you are, a pension plan or an insurance company, what are you doing? The European Central Bank is buying even now corporate bonds. This was the last area where the insurance and pension funds could make some, sort of decent kind of return. It's gone now. So they can only invest in, in equities, which is a very volatile market, or going into real assets. And I see the same happening, in infrastructure. Our infrastructure funds, the prices are rising. For aircraft, the same. it's always the same.
Annette slightly anticipated my question, and Franz has slightly answered it. But Stefan, where are you still seeing value on the other side of things? Where you anticipate where there might be some more yield compression? Any particular markets?
Since we are only active mainly, in Germany and Austria, I see there's only yield compression. We just bought something in Budapest, in Hungary, which I believe was a really clever move because, the yield is very attractive over there. There are some markets where the yield, I believe, is in the right correlation to the risk you're taking. But saying you wouldn't buy anything, I wouldn't buy in Hong Kong, for example. Yeah, but other than that, you will always find value somewhere. Yeah.
Tom, you're the one who should have the answers, really. You're the one who's kind of advising all these guys, looking over across the market. Come on, where's the value to be found?
Where's the value to be found?
We see some more yield compression.
I think so. I showed a chart to some of our UK clients the other day, which startled them and made their UK regional fund manager very happy. And that was it showed that the yield gap between London and sort of the big regional UK cities has increased by 10 times in the last 10 years. So there's been a complete dislocation in the UK between pricing in London and pricing in the rest of the big UK regional cities. And London's a global market and it prices globally, I guess, rather than on the basis of what's happening in the UK. But I think there's probably a good story to be told in some of the UK regional cities that have strong local economies, relatively liquid markets, not very, very liquid, but quite liquid. I think I also like the fact that, infrastructure improvements are taking place in parts of the UK, the Northern Powerhouse, which is improvements to transport links in the north of England. So places like Leeds and Manchester and Liverpool, maybe there's a bit of a story to tell there. So possibly a bit more yield compression.
Sounds like good advice to me. Well, we've got a very healthy audience, and I'm sure, as requested, you've got some burning questions that you'd like to ask the panel. Who'd like to be first? Wow, there's an array of hands. That's good news. That's what we like to see.
Thank you. A question on yield gap and total return, and focused on German office. Firstly, if I got that chart correctly, you showed us the expected rental growth for the next 3 years, and I was a bit surprised to see that this should have been 2% across the top 7 cities in Germany. So the combined question would be, if you look at total return, what would you expect from rental growth? And secondly, as office buildings don't get younger over the investment period, what are your expectations with regards to, for example, annual capex, which is obviously not captured if you just look at the yield gap?
I think that might be one for you, Tom.
Well, I'm not an investor, so I can't tell you too much about annual capex. That's maybe for Annette and Stefan. It's looking hopeful. Look, those forecasts are produced by the IPF, so they're consensus forecasts. Now, whether you believe them or not, I guess, is one thing, but that's certainly what the institution, most of the providers of those forecasts are institutional, so that's what the institutional investors and some of the brokers are saying about what's happening in terms of rents in Germany. If you look at the occupier fundamentals, they seem to be aligning in the right direction for rental growth to happen. Relatively low levels of good quality stock in some markets. I think also, you have to differentiate between, Munich, Hamburg, Frankfurt, what have you. This is not a blanket comment. So there's local market idiosyncrasies. Thank you, David. So I think there's a story there in terms of what's happening in the German office market. I don't know whether Annette and Stefan comment on CapEx and
rental growth, I guess.
More specific matters of the investment horizon.
Well, maybe in terms of rental growth, I think that is the good story about today's market, that we have seen vacancy levels come down a lot because of limited construction activity. Over the last years in Germany, we are seeing some real rental growth, so that's a positive story to be told there. We feel that there are some cities that will likely outperform compared to others, and it's really Munich and Berlin where we see most dynamic within the German markets right now, and that are most constrained, especially for occupiers looking for larger space requirements. In terms of CapEx, not exactly sure what you're looking for. It's very much asset specific, if it's a euro number or percentage number. But clearly a building that's 10 years old will need some level of maintenance, and that may or may not impact the yield depending on the market you're in then now. I don't know if you anything to add.
Yeah. I think real rental growth, I'm always cautious about this one. I mean, what I see is the first time rent is always the highest rent we can ever achieve in our buildings. I mean, all across our buildings, since we are doing this since 40 years, I haven't seen a real rental growth in office buildings for the last, let's say, 10 to 15 years. Because we always, when the lease runs out after, let's say, a 10-year lease, then you have 15 euros at the beginning, you escalate it up to 17, 18 euros. If you're happy, you just drop back to 15 euros finally. And you also have to spend CapEx on it, rental-free periods of time. I mean, it's just reducing it. If you're on a bad period of time, you have to give a lot of rental-free period or a lot of costs for CapEx as well for the lessee. If you are lucky right now and the lease runs out, you might get, better pricing on it. I would say if an office building is in the range of, 20 years old, then you really have to spend a lot of money. I mean, honestly, this is something, don't fool yourself. I mean, you have to spend maybe up to, I would say, 20% of original purchase price on it, because you have to redo everything. I mean, especially, you know it. I mean, the communication technology is growing, data volume is growing. I mean, you have to just redo everything, and this costs you a tremendous amount of money just to be competitive. It's not like, you can upgrade a 20-year-old building to a Class A office building again and compete to newer ones. It doesn't work.
I think there are a few more hands over here. There was, anyway.
Hello. I would like to ask you, how do you see the Brazilian market, if possible?
I don't know. To the extent that I can comment on the Brazilian market, what I will say is that RCA has just invested in a Brazilian data partner. So we've taken an equity stake in a business that's providing real estate information in Brazil. So I can comment to the extent that as a business we see growth there. I think in terms of investment volumes, very low levels according to our data at the moment.
I was incredibly impressed by how quick you picked up that microphone.
So I had my one bit of Brazilian knowledge, I had to get in there.
Any other views on the panel on the Brazilian market? Sorry, we've drawn a blank with the rest there.
I wonder how deep will the yields fall yet? I remember a while ago, Olivier Piani said that there's a minimum yield gap around 3.5%. I think that was around 2 years ago. Is this still valid, or is the yield gap declining?
It's got to be one for you, Annette. It's your former boss.
Interesting to hear what he said. Every time I've been asked those questions over the last years, it was always hard for me to imagine that yields would fall even more. And every time I've been proven wrong, and they have fallen more. And based on everything we're seeing currently in terms of the liquidity coming to the market and what is happening in terms of interest rates, there is an overall view that there will be a further decline, probably by 10 or 20 basis points on the office side, at least in Germany, by year end. And I would not be surprised if that happens. Is there a minimum yield that can't be exceeded? It's hard to say because it also depends on financing conditions, availability of financing, and what that really then relates or equates into in terms of equity returns combined with the real estate story and the growth story behind it. So I wouldn't want to give a numbers answer on that, but I do expect further declines.
I would say the same. As long as you have, let's say, 250 to 300 basis points difference to government bonds. I mean, especially in Germany right now, government bonds are 0 or even negative, and you have 300. Let's say you buy for 3.5 point or 4% cap rate, you should be fine. If it falls below 300 basis points, then I would say, oh, it's getting tight.
The only thing I'd add to that is that if you look at the top of the last cycle in 2007, office assets in London were trading at below UK 10-year government bond yields, and so there was actually a negative yield gap. So clearly that was madness at the time, but it shows that investors will bid down assets to below that, or they have done previously.
Incredible. Any more for any more? We've got time for one or two more questions, I think. No one tempted? We can see a running microphone. There we are.
Hi there. I would be interested in your view on the CEE markets and how development is there.
It's got to be one for you, Franz.
As I mentioned before, in the CE market, the yield didn't come back to the level it was in 2007. If you have seen this first or second slide of your presentation, it was CE on the average. In 2007, there was also Hungary very strong represented and Poland lesser. So today, only the Polish market, and especially Warsaw, has seen cap rates which are below 2007 level. The secondary cities are about as they were. Hungary is much above, so there's still a potential. And Prague is somewhere in it or slightly below. Romania is above, and I'm not speaking of southeastern Europe, they're still highly above. So from a potential point of view, I would say the more mature markets are Poland, because it's the most liquid one, Czech Republic, so is Prague, and Budapest, and to a lesser extent Bratislava and Bucharest. There's still some potential, whereas Warsaw has already anticipated a lot of the yield compression. The other markets in the secondary cities in Poland, they still have a potential for further yield downshifts.
Just wish as a last question to ask Tom, if you see any China capital or Asian capital coming to secondary UK cities, and would the office product, let's be attractive to Japanese insurance companies, for example?
Yeah, we have seen Chinese capital come into the UK regional market. So the name escapes. I think it was CIC bought a huge office block in Manchester not so long ago in a joint venture. So yes, we have seen that.
Ginkgo tree, wasn't it?
Yeah, Ginkgo. Okay. Yes. Well done, David. So yes, we have seen that, and they're not the only Asian players to invest in the UK regional cities as well. We saw Mapletree buy a huge office park near Reading recently. I guess there's limitations in terms of the availability of the lot sizes that these players typically want to invest, 100, 200 million plus lot sizes, and there's a number of those in those markets. They tend to be more the 20 to 50 million lot sizes that have been dominated by a lot of the UK institutional players. So I think, like I was saying earlier, you can create a story about investing in UK regional office markets, but I think it's the type of stock that's available to be bought that might be a limit.
Fantastic. Well, thank you ever so much, guys. I think that's been an excellent discussion. And please, could you just thank the panel in the usual way? Thank you.